Every number tells a story, and some stories, they just don't add up. Vang Magazine Company started construction of a warehouse building for its own use at an estimated cost of 5 million pesos on January 1, 2024, and was completed on December 31, 2024. But the financials raised suspicion. A warehouse was built for 5,200,000 pesos. Along the way, interest was incurred. The president, Jane Edu, has been shown the costs incurred associated with this construction project and capitalized on the statement of financial position. She is bothered by the avoidable interest included in the cost. She argues that all interests are unavoidable. No one lends money without expecting to be compensated for it. Second, why can't the company use all the interest on all the loans when computing this avoidable interest? And finally, why can't her company capitalize all the annual interest that accrued over the period of construction? That's why we are reopening the books, and I've called in my top 4 agents to investigate. Each of you will take a piece of this puzzle. In a memo dated January 15, 2026, we need to explain what avoidable interest is, how we computed it, and why the company cannot capitalize all its interest for the year to Miss Jane Edu, so she will not raise any suspicion to the capitalization. Let's uncover the truth. Agent 1, you're up.
Yes, Chief. Here's what I uncovered. Just the facts, straight from the books. During the construction period, Vang had the following borrowings on record. A construction loan of 2 million at 12% interest payable semi-annually issued on December 31, 2023. A short-term loan of 1,400,000 at 10% interest payable monthly with the principal due on May 30, 2025. A long-term loan of 1 million pesos at 11% interest payable annually every January 1 with the principal due on January 1, 2027. The total cost of constructing the warehouse came out to 5,200,000. But here's the key number. The weighted average accumulated expenditures during the construction was 3,500,000. Here are the full charges accrued over the year. But remember, according to IAS 23, just because interest is incurred doesn't mean it qualifies for capitalization. That's why we dig deeper. Agent 2, analyze the general borrowings and compute that rate.
Right, boss, let's walk through the process for determining the capitalization rate for general borrowings as required under IAS 23 borrowing costs. We're focusing only on the short-term and long-term general loans since any expenditures not covered by the specific loan will be subject to capitalized interest using a blended rate. Here's the breakdown. Short-term loan of 1,400,000 with an interest expense of 140,000. Long-term loan of 1 million with an interest expense of 110,000. That gives us a total of interest of 250,000 on 2,400,000 in general borrowings. Using this data, we can calculate the capitalization rate as 250,000 over 2,400,000, which is 10.42%. This 10.42% blended rate now becomes our applicable rate for any uncovered portion of the qualifying assets expenditures. Let's say our total spending on the qualifying asset is 5 million, and we already covered 3 million with a specific loan. The remaining 2 million is now exposed to general borrowings. So applying the 10.42% capitalization rate, the avoidable interest we can capitalize from the general borrowings is 2 million times 10.42% is equal to 208,400. This interest is added to the cost of the asset not expensed immediately. Here are a few key things that we must maintain transparency in the allocation of borrowings and ensure the documentation supports this treatment. Avoid any misapplication that might defer expenses improperly. This is both an on-accounting and ethical issue. And of course, we should disclose our assumptions and methodology in the notes to the financial statements as required under IFRS.
Alright, Chief, so the mystery here is how did they come up with the 396,300 pesos in the avoidable interest? Easy, balance, we follow the money. We start with the weighted average accumulated expenditure of 3.5 million pesos, we then deduct the specific loan of 2 million pesos, and that will leave us with the 1.5 unaccounted for. Exactly, that's where the general borrowing comes in, and the rate 10.48%. To get the specific interest, we will multiply the 2 million by the 12%, giving us 240,000 pesos. And for the general interest, we will multiply 1.5 million by 10.48%, giving us 156,300 pesos, and having a total avoidable interest of 396,300 pesos. So that's it, 396,300 pesos, the exact number on the report.
Remember, avoidable interest is the amount of interest to capitalize is limited to the lower of actual interest costs incurred during the period or the avoidable interest. It is the amount of interest costs during the period that a company could theoretically avoid if it had not made expenditures for the asset. We use this figure, not the full interest expense, because IAS 23 limits capitalized interest to this threshold. Agent 4, issue the final verdict.
Alright, boss, let me wrap this up in a clear and simple way. We already know that the total cost of the construction building is 5,200,000 pesos, and the total interest incurred is 490,000 pesos, and avoidable interest of 396,300 pesos. What does this mean? It means we can only capitalize 396,300 out of the total interest. That's the amount that's related to building the warehouse as per the rules in IAS 23. So we add the interest and the cost of the building, and we have 5,200,000 pesos, the construction cost, and 396,300, the only capitalized interest out of 490,000 interest incurred, which equates to 5,596,300 pesos total cost for the warehouse. The rest of the interest, which is the difference between the total interest incurred and the capitalized interest, which equates to 93,700 pesos, which will be recorded as an expense. Here's the journal entry for the year 2024.
Excellent work, agents! You followed the standards. Avoidable interest identified, misstatement prevented, and President Adu may question it, but the international accounting standard speaks louder than opinions. Only what's justifiable gets capitalized. The rest, that's for the expense ledger. Another case solved, another balance sheet set right. Let's move out